Hey everybody, it's Greg Rice. We're here in Middletown, Connecticut, and we're with Mr. Chris Nielson. How you doing?
All right.
Of Northeast Financial. And before we get going today, I wanted to send a shout out to our mutual friend, Mr. Nick Green. Nick was the guy that introduced me to you, and I want to say thank you to Nick. And I want to jump in right now because Chris is very unique, okay? And as I was sitting in his lobby ready to get going here, I was looking at some of the non-traditional loans that you have that set you apart greatly from many lenders. And for people like me that own property, okay, I'm reducing my income at the end of the year legally to be as minimal as possible. So when I come for a traditional loan, lenders say, we'll give you a library card if you want, but I'm not getting a loan easily. So tell us about some of the non-traditional loans that you have and how they apply to certain trades.
Sure. So non-traditional loans are not like they used to be in 2007, 2006, before we had the crash, right? Like it's all, that was subprime, and they were pretty reckless. People were just out there giving money to anyone. We actually had one of our old LOs in today. He took us out to lunch because we did his loan for his family. And pretty difficult self-employed guy, by all means, to get done. And he said when he bought his first house, he had no business buying a house yet. He got approved. It was stated income, stated assets, state you're hoping, we just give you a loan.
Wow.
So that garbage is gone, thank God. So that's going to keep our housing economy from crashing. But there's been some resurgent, right? Stuff that's come back. So, you're looking at our non-traditional stuff.
Yeah.
We call it non-QM, right? Non-qualified mortgage. So all that means is it's not fitting into the Fannie Mae, Freddie Mac, FHA, VA, USDA box, or even jumbo in some cases. So they've opened up the ability now. They always have to have an ability to repay. So the ability to repay will be different depending on the customer. And what that means is basically if the lender sees that this person has the ability to repay, so the stated is gone, then they will offer them financing. So some of the ones that are attractive, particularly for self-employed, the two big ones for self-employed are bank statement loans and 1099 loans. Let's talk a little bit how they work. Right? All right. So you're a 1099 worker, right? You're a gig worker. You're doing Uber. You're doing
bartender.
The bartender is usually W-2, but bartender might fit into that bank statement piece. But it's really the person that's a true contractor, right? They get a 1099 every year from whatever it is they do. A lot of contractors do this. Realtors will fall into 1099, things like that. So what that means is instead of using your tax returns, because probably if they're just them, it's a Schedule C, they're smart, they write everything off. Sure, they brought in $180,000 this year, but you look at their net income, which is line 31 on the tax returns.
Pennies.
And it's $15,000.
Right.
They can't buy a toaster, more or less a house. So what happens is the lenders use a 90% factor of the 1099.
Wow.
So if you think about it, we work off gross income for a regular employee, right? And that person has all of these deductions, right? And everything they put away, but we're still using the gross figure. Well, why wouldn't a self-employed person get a similar take? So the 1099 loan is actually one of the more aggressive ones and very easy to do, right? So you got a laborer, someone that just gets a 1099 every year. It's pretty simple. You're going to take the last year or 2 years. So use 1 or 2 year average. And you take 90% of that number, and that becomes your usable income to qualify. And that's the difference between doing a deal or not doing a deal.
Interesting.
Big difference between the past and now. The past, that person would get into the house with no money down. Now they could get into a home with as little as 10% down, but they need stronger credit.
Gotcha.
Doesn't need to be perfect. Typically 640 and up, which is not the best credit score out there, but they do need a little bit more ability to repay, as they say, than just I haven't paid anyone and I've got this for income. That's the 1099. The other one is the bank statement, right? And this is popular for true self-employed people that just have massive cash flow. And they don't get 1099, right? They pulled in property investors, right? All different types of things. I've got a guy who owns 12 Jersey Mikes, and his cash flow is $4 to $7 million a year just in people buying sandwiches. There's no 1099 for him, and his tax returns are so insanely complicated that at some point you can't qualify him for any more house. The bank statement becomes a great product, and the way the bank statement product works is they typically use 50% of deposits because that's a little bit different. That's a true
Average
cash flow.
deposits?
Yep. So
along how many, 24 months?
They will do 24, 12, and there are some lenders out there doing as little as 3.
Ooh.
So you've got all different spots. You know, as you get less income, you need to put more down. Correct. It's the best way to put it, right? The worse your credit, the more you put down, less income, more you put down. But they always start at 50, which means, you know, you make $100,000 a month in deposits, it's going to give you $50,000 for income, which is a ton of income to use. And particularly like a contractor or someone's got massive cash flow coming in, that really helps them get to a spot that's a little more usable. And then, you know, the other piece of it is, if you have your accountant write your expense ratio on there, they will go a little bit deeper into it. So for example, you're a consultant, right? And you're using your bank statements for cash flow purposes and to do the loan. A consultant doesn't have a lot of expenses, right? Like, I mean, they're just kind of moving from place to place. Maybe they got a computer and some overhead. So the accountant can write a letter and say, you know, Greg's expense ratio is 10%. So then they'll use 90% of deposits instead of 50% of deposits.
So you could kind of offset the...
Exactly. Yeah. If it fits the business,
Makes
you
sense.
can do that. You know, it's not going to work with a restaurant. The lender's going to look at you. There's common sense, right?
Rental properties, anything like that.
They're going to be like, not so much.
Yeah.
But when you get someone that, you know, needs a little bit extra than 50, the option's there, right? It's just got to make sense past the sniff test and you're good to go. So what's happened in the market is, you know, these people have been shut out for a long period of time from getting homes because of all the regulations that came in after the crash. So now it kind of started to institute these here, right? And there's lots of other types. They're doing ones on assets for income. So people that, you know, sit on a pile of money, you can take that money and divide it over, you know, as little as 60 months and use that as your income.
What about like people that have a trust fund? Can that money be...
Absolutely, as long as you can verify they own, depends on the lender, usually at least 10% of the trust fund.
Gotcha.
Something more like 20, 25 in some cases too.
Yeah.
But yes, if you can verify that they have access to that trust fund money and they can take it, the tough thing is reading through those trusts. Right. So it's usually a little more difficult. But what we've seen, and I've done these before for people like that, the people that are, you know, quote unquote trust fund babies, they got plenty of their own money in their own account too. So they've built it up over time. So they're not using a trust account. They're using something else.
Interesting. So who are these mysterious lenders that are funding these type of loans?
Yeah. So, I mean, people will be shocked, right, when they hear it, right? So let's take Flagstar Bank, you know, or Citizens Bank, or actually Citizens isn't doing it, but Flagstar does something like this. United Wholesale Mortgage, the largest lender in the country, they do this. Rocket Mortgage does them. And as a broker, I sell to everyone. So
you don't care.
It doesn't, you come work with someone like us and you get all of the lenders at once because we're going to kind of find the right fit for you and go out and shop you out to all the different people. But it's become very mainstream because there's a real void in the marketplace right now. You know, getting qualified for a mortgage right now with interest rates currently in the 7s, if anyone's looked recently, is difficult for a lot of people on a modest income. So sometimes you need to find these alternative spots, and these are not really for people that for modest incomes. These are for people that actually make money,
right?
But just don't show it.
Minimize it,
right? You know, and they've brought back the other products too. The other big one that is like really important to the investor space is the debt service coverage loan. Do you know what debt service coverage loan is?
No.
Okay, so they're pretty straightforward. It's usually a 1-to-1 ratio. So they say a ratio of 1, right? So what does that mean? That means if your mortgage, taxes, and insurance, and if it's in an association, HOA fees together, all added together are equal or $1 less than your prospective rent income on that property, you qualify.
Wow.
And that's only for investment properties. Okay, it can't be a second home. It's got to be an investment property. We can do them on those Airbnb seasonal homes, and they always ratio because the amount of money they pull in on those things is ridiculous. And you're looking anywhere between 20 to 30% down, depending on your credit score. But the most amazing thing are the rates with these. So these debt service loans right now are pricing out equal or better than conventional loans. So if you went to a bank, Bank of America, Wells Fargo, Chase, big name, brand name bank, and went to go get a non-owner occupied investment property loan, unless you've got some massive special deal or a really good angle, your pricing is going to be in the 8s based on current rates today, right? So we're September 21st, 23, so I don't date myself. People look at it and be like, your rates are there.
Yeah.
But either way, where rates are today, you're going to be in the 8s and you're going to be paying points.
Yeah.
So what will happen in this case, on all of these non-traditional loans, you are going to pay some points. It's part of the market right now.
Generally, how much? Just so they know.
So I would say, typically between 2 to 3 points is probably the average that you're going to pay. And a point, for people that don't understand it, is 1% of your loan amount. Okay, it's not a bad thing. All it is creating the interest rate that you're getting. So if you did a no point loan, your rate would be much higher versus doing a loan where you may pay a couple points. So real life example on those debt service loans, like I said today, a non-owner occupied investment property is going to price in the 8s with, call it, 2 points. Okay, so 8 1/8, 2 points. We currently have outfits, and I've got a loan going right now, investment property, over $1 million, pricing at 7.5 with 2.5 points. So half point more, you get a whole point less. And in today's current rate market, we don't know when they're going to come down or if they're going to come down any day soon. That's a really good deal. For an investor, it's speed, right? So the market, with the tight inventory and the hyper competitiveness, cash always wins, right? But if you don't have the cash, if you can move fast, that's the second best option. Right. So we spend a lot of time here at Northeast educating our realtor partners on the sell side. So we actually encourage, a little bit different than some other people on pre-approvals, we encourage the sellers, realtor, sales representative, to call us, the lender, directly, so we can talk to them about our clients and kind of almost like brag about our clients, right? So, but part of it too is there's a lot of education that needs to take place. They see something that says non-QM or non-traditional, and everyone pumps the brakes and says, is this some sort of shady practice, or, is this going to fall apart at the table like they did to me 10 years ago? Not really. It's not going to happen at all. Honestly, these are much easier to do, but sometimes after explaining to someone how the process works and how it all comes together, you end up with a really good deal.
So have you built a reputation with Northeast Financial amongst the realtors over the years that you've been here?
So yeah, we've been here since 2008.
Okay.
So
good timing.
We are the I think we still are. We are the largest broker in Connecticut. Wow. So I've got over 20 LOs that work for us here. Wow. So we cover the whole state. Awesome. We work in North Carolina and Florida as well. So we've got presences in those states as well. And yeah, I think we've got a reputation. If you look us up online, our reviews are very strong, right? People like working with us.
4.98 out of 5 stars, and that's 286 reviews.
That's an old flyer. So it's over 400 now, and it's over 4.9. So
that's crazy. That's like one person that gave you a sour note.
Absolutely.
Just one.
Yeah, it's 2, I think, last time I checked.
Perfect batting average.
And I know both deals, which is kind of the crazy thing when you think about it.
You probably disagree with it.
No, we wrote the response. I encourage people to go read it. Read it and see it, and then read every other review that person's done, because usually someone's got an axe to grind. They're going to grind their axes with everyone, and they don't say thank you to many. But either way, I think we built a reputation of just doing the right thing and doing things the right way. Kind of like the way you and I met too. Yeah. Didn't end up personally doing your loan.
Yeah, but very grateful.
Made sure you were in the right spot.
Yes.
Right.
So I think very transparent, very honest, very upfront.
And that's I think another thing to segue into that we should talk about is like transparency in this industry, especially for people on the market right now shopping for a good deal, something they should know. I really encourage that people demand transparency in this business.
In what way?
In understanding what the fees are, what the rates are, what they're really getting in return for what they're paying for. It used to be everyone kind of could do everything with a no-point loan on a conventional, traditional side. And, it was really, you could shop, right? And you could say, all right, this rate's 6%, this one's 6.5%, all equal. I'll go with this one. And then the APR piece, which is the annual percentage rate, takes into the fees that you're dealing with it. The problem with that is no one really understands how you get to that number, and it can be really confusing. So what I always tell people is, and what we do here too, is we provide people a full fee sheet with their quotes.
Yes.
So a couple things with that. You never need to have your credit pulled to get a quote. So anyone that tells you that, they're trying to sneak you into a loan. They're not looking out for your best interest. You should be able to get a quote on a soft pull only. Soft pull doesn't affect your score. It will give the lender an accurate depiction of your credit score, at least one of them, if not all of them. And it gives an accurate depiction of your debt load so they can make sure that they're getting you into the right product.
Makes sense.
If anyone is going to do a hard credit inquiry to just tell you what their rate is, just run away. Like I would just go somewhere else. They're not looking at your best interest, right? If they don't have the ability to, it's not their fault. But, I would say every place really should be able to do that at this point. So kind of coming full circle on that, once you have that quote in hand, you need basic things, right? You need to compare all of the lender fees, the points, if any, plus all of the other fees on the file. And then the things to kind of understand when you're looking at buying a home or your first home or your second home or your 50th home is there's certain fees in there that are negotiable and there's certain things that aren't, right? So you can negotiate what your attorney pays you. You can negotiate what your insurance is going to be. But you can't negotiate your property's taxes. You just can't. It is what it is, right? And you're not going to negotiate the appraisal fee. And you're not going to negotiate the lender's fee. So there's certain things that are going to be set in stone on there, and they're going to be listed out. And what every good loan officer should be able to provide you is a clear fee sheet that breaks down all of the fees that you can clearly understand and compare to someone else. And if you're dealing with someone and they offer you a better price or a better rate, and they can't give you that same level of detail, they're not really taking your best interest in mind, right? They're trying to hide something. Like there's nothing to hide in this business. Everyone is basically really close to each other. It's just a level of experience.
And you're a broker, so there's a connotation that brokers are more expensive.
Yeah.
So what do you say to that? Taking this into account that you're doing traditional and non-traditional loans.
Yeah, so I think what I do, which is a little different, and thank God for technology, I think is pretty cool. I actually take my customers behind the scenes and show them my broker price so they can understand it. And then I encourage them to shop me at the same time. I say, just go for it, and
take it.
Exactly. Take this and run with it. We'll see you in about 2 days. And it usually, it's conceited, right? But it's also the right way to do it. It's honest, it's fair, it's transparent.
Yes.
So as a broker versus a lender, a little history about myself. I was a large lending manager for many, many years at a top 4 lender in the country. For a better part of 20 years, I was in management. I left that to do a small local business because I like this better, I want to be closer to my family. I know how lenders work. So on the retail side, as a lender, it is very expensive to generate business. Marketing is expensive, compliance is expensive, your warehouse line is expensive, everything is expensive. As a broker, I have to pay my staff and I have to pay me and maybe some rent and some compliance material, things along those lines. But it's a really lean business. My marketing expense is a fraction of what theirs is because I'm not trying to feed and run commercials on the Super Bowl and stuff like that. So what happens is you take that same price, you go to anyone who's seen like advertising a great rate, it's like 7.5 here, right? And I'll show 7.5 with no points too, and we'll show them together. And then people are like, well, where do you make your money? On those non-traditional loans where we start, it's easy. I just show them, hey, I make my money on these points. This is it. On a traditional loan, the points are not mine. That's all part of the pricing. So I just show them, hey, the lender's going to pay me X for this loan. Okay, and it's fully disclosed too. Like they see it on the transaction. Like there's nothing hidden there, which is nice, and I prefer it that way. Where as a lender, they never have to show you that. So what ends up happening is your rate is always higher at the lender with no points than it is with us because they got to cover all of their costs.
In with all that stuff.
Exactly. Because what happens is with that file, after it closes, and everyone complains about their mortgage getting sold, this is exactly what's going to happen. That lender is going to take that file and now sell it or securitize it, you should say, like with Fannie Mae and Freddie Mac, the 2 biggest investors in the country, right? They're going to pay the lender a fee based on the interest rate that they provided. It's the exact same way the broker gets paid. It's the exact same way. The difference is instead of that lender having to pay their sales rep a bloated commission, the marketing people, the compliance people, and all those people along the way, they're just paying me. And I'm asking for less than what they have to spend to get their own. Hence the reason why it's cheaper. So like the best example, we show people sometimes is because we are a Rocket mortgage broker too. We can show them Rocket's rates online, and I can show them mine right next to it, and it diffuses the whole situation instantly.
And I remember I was dealing with Loan Depot when trying to get a bank statement loan, and I remember your words. You said, I believe you said, I'll go toe to toe with Loan Depot any day.
Sure.
And I remember that stuck out in my mind because I was like, wow, Loan Depot, which is on the side of a stadium in Cleveland, commercials on the Super Bowl, and little old Chris from Middletown was like, I could do it.
Yeah. Well, I mean, we were partners with UWM. Shout out to them, right? I don't know if you know Matt Ish, but he owns the Phoenix Suns. We got that guy. So we got, our own person that all they do is wholesale. So you can't go to them directly as a retail person. You have to come through a broker to be able to get a loan from them.
Yeah.
They're the largest lender in the country. So that just tells you the power of the broker channel on what we're able to do for people. And I think it just gets some time getting used to it, right? It's no different than working with an insurance broker or something like that. It's not, it gets a connotation until you actually put the numbers. That's why I always say transparency is key. When you put it all on paper, it all adds up.
And what does the future hold for the industry, folks that want to buy a house, people that want to buy investment property? What's your opinion based on your so much experience, over these 3 decades?
We've been here before, right? So when I started this business in 1996, the average loan, I want to say we were writing, was in the teens. 13, 14% was not unusual.
But prices were a fraction.
Prices were a lot cheaper. Yeah. So we've been in worse, right? I've seen worse. 2000 was pretty awful in terms of what happened in the market. This is maybe the slowest I've seen it on the lending and real estate side, I think, in my career. So that's spanning all the way back 27, 26 years. But it's not a reason not to buy. So it's really, to me, it's always math. And it's just leveling your situation on where you want to be. Owning is always going to be better than renting over the long term, just because you're building equity, you're building an asset. You're not going to be told to move in a couple months. It's not going to sell a property on you because the market's hot. Like you're getting yourself all that stability that you want and need. And I think lenders and the country and places are adapting to that, right? We saw that in Connecticut. We've got something called CHFA, which is CHAFA. CHAFA, it offers down payment assistance for low to moderate first-time home buyers. They wrote out a program 2 years ago now called Time to Own, which was basically free money. Not the easiest thing to qualify for, so it was marketed really well and people came for it, but a lot of people couldn't get it.
Gotcha.
But they have other products there that are still a great serve, right, to help people that don't have the down payment money. Because it's expensive to get a house.
100%.
But there's lots of different things, and I would say as this market starts to open up, we are seeing homes sit on the market a little bit longer than they were. You'll start to see some of the competitive things on the selling side come back, and we can start introducing different avenues to help people qualify and get them in terms of seller concessions and things along those lines that could either lessen the cost or lower their rate initially.
Yeah. So you're hopeful.
Oh, yeah. You just got to stick with it. Stick with it. I would say this has been our slowest year in some time. Last month, personally, was my biggest month in about 10 years. So it's a matter of just perspective, right, on how it goes. And really, for us, most of what we do here, we kind of have 2 avenues, right? We've got the investor avenue where we do quite a few business, with those debt service loans and that for people like that. But then we also have the first-time home buyer, which we do a ton of. Like that seems to be our biggest focus here. That's great. You're helping people in the community. Yeah. We're local. People want that. Yep. And then they also want to know they have confident people.
100%. And how do they get in touch with you at home?
So a couple easy ways, right? You just go to our website, which is northeast-mortgage.com. It's all spelled out. Or just give us a call, 860-788-7237.
And what about the old school walk-in? Do you still get walk-ins?
We do. Did you see our sign?
I saw the sign.
Yeah. So we're on Route 66 here in Middlefield.
Busy road, yeah.
30,000 cars go by every day. We get a couple walk-ins every month.
That's fun.
It's entertaining, to say the least. But we do get people, and we have gotten business out of it. So I mean, you can come see us for real people.
Back in Rhode Island, when I got started with the management, I was in the office like this in Pawtucket, and an old guy walked in and he said, "I want to buy investment property," and I was like, I'll walk in.
Yeah. You never
And
know.
he turned out to be our biggest client.
Yeah, absolutely.
Bought 50 units. He's giving them to his kids. Like, you never know. So, awesome. Thank you, Chris. Thank you for your time.
Thanks, bud.
And if you have any questions for Chris, put them in the comments field below. We'll get right back to you. Once again, Greg Rice here in Middlefield/Middletown. Where are we?
Middlefield, but I mean, in between Middletown and Meriden. So.
We're right here. Your property managed.